Hi everyone, and welcome to Macro and Global Liquidity Analysis Gold, Silver and Bitcoin Monthly Update for February 2025. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto and the Gold and Silver Standard. I'd like to start by welcoming Joe and Paul to the panel. How are you today, team?
Very good, thank you. Fresh off an interesting night last night, so...
It was an interesting night last night. Joe, how are you?
Yeah, good, mate. Let's get into it, eh?
We've been discussing this stuff sort of non-stop over the last few days, behind the scenes, because we're just there is a lot going on in the markets at the moment. We seem to say that every month, but it's been just such an interesting start to the year that we've had to convene quite regularly and actually get to the bottom of what's going on. So there's a lot we can actually dig into today that I'm quite excited about. Before we do that, however, I'll just remind everyone that this is everything that we show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. So, as I said, lots to discuss. We'll use our usual format here, the sort of where we are in the cycles stuff, the deep dives on liquidity cycle, macro cycle, and Bitcoin, look at gold and silver, and then tie it all together with a simple trading plan that people can follow along. That has been doing very well for the last quite a while now. Actually, it's a couple of years with it. It seems to be gaining on. But let's start off. We made this point that it was going to be a tricky year. We've made this point for a little while now. I think we were even saying that back at the end of last year. And our first slide here, where we're looking at where we are in the cycles, really highlights it, right? Because just today we've got this strong bear market flashing signal there in the Bitcoin cycle, relatively inconsistent with what we're seeing in the other parts of the cycle. We'll dig into the charts on that specifically in a second. Paul, in the discussions that we're having around this, what's your take? What's your perspective on how you approach a period of time like this in the markets?
I guess this is the exact example of why our framework is so important. Because if you were looking at that one down the bottom in isolation, you could be bailing out or at least not particularly comfortable. So again, we need to look at the context of any... Bitcoin is a volatile market, right? So we always need to look at the bigger picture, because what feels like a large volatility, when you zoom out and look where you are, is just par of the course. So again, we look at liquidity cycle, we look at where we test that again against where we are in the global macro cycle, and then we can look at where we are in Bitcoin with that context.
And that's so different how many people, many analysts look at it, because they get so caught up in the Bitcoin chart and following what's going on there that it makes it really difficult for them to be able to see the bigger picture. That's what we're attempting to do. Let's do that by looking at this chart, which we pull up every month. Joe, this idea of our macro cycle indicator combining really where we are in the two parts of that Paul just said were really important, where we are in the global liquidity cycle against the backdrop of where we are in the business cycle. Both of them have also been a little bit challenging over the last few months, but in hindsight, probably is actually painting a fairly clear picture.
Yeah, so we've had a couple of revisions on that over the last couple of months. So those dots have moved around a little bit, but it's sort of at the end, like we've spoken about previously, as long as you're in that early mid-cycle, the asset allocation doesn't really matter too much. It's still risk on, especially where, as we'll talk about as we go through this presentation, with where expectations of liquidity momentum and where we are in the business cycle, stuff like the ISM, inflation and whatnot. But, we'll also probably touch on why it's been a little bit choppy, and that's generally regards to this cycle's a little bit more drawn out due to inflationary pressures over the last couple of years and the reluctance of central banks to provide liquidity into the market to in the fear of stoking inflation fears again. So, I'm not sure. Do we have that heat map on this presentation?
Yeah, and I'll pull that up a little bit later. We'll dig into some of that specific, but yes.
Yeah, we'll reference that and we'll talk about more there.
Yeah, because that's a really good point, that when you look at it across the spectrum, it paints a very interesting picture. The one that is going to have a lot of people really focused on at the moment, Paul, is what you were saying before, that Bitcoin strong bear market. And when you look at this chart, there were warning signs there in the orange. So the question's going to be, why are we still in when we had a warning sign there in the orange? Because a big red bar's occurred, right? Like we got that sell-off.
Mm-hmm.
Now, it also could have been a big green bar. We don't know the answer to that question. Lots of people will be patting themselves on the back saying, well, the moment there was any sort of sign of weakness in the market, I bailed out. I took my profit because we'd had that big rally. How do you process that?
Again, going back to what I said before, I can look at that in through the lens of where we are in the cycle, and know that there's just math. There's just certain realities out there in terms of where we are from a debt point of view. That means that liquidity must come, and I think we show a chart later. There's no better correlated asset with liquidity than Bitcoin. So whilst we have that faith in just reality and facts and math, then we can look at this through that lens and see it as a buying opportunity rather than a bailing opportunity.
And I mean, we may get pushback on this with people when they're watching and going, well, you missed it there. But I feel very comfortable in our analysis of this so far, because what we're expecting is quite a rapid turnaround in this, which we'll go through as we break it all down. But we're expecting it turns around and heads back up. A lot of people will probably jump back into this market who have bailed out only when it breaks the all-time highs. And Joe, that's still a long way from here, right? So that's a lot of missed opportunity for people who were skittish on the sidelines and went, oh, well, I needed to get out. When do I get back in? It becomes probably the hardest question of all in navigating these markets, is when to get back in when you get out if you don't have a framework.
Yeah, particularly if you're someone that, you see those sort of market highs, particularly around where those yellow bars occurred, and all of a sudden you get a red bar and you feel vindicated in that you're correct, and you get that sort of recency bias, and you believe that it's going to keep going down. You just don't get back in. So, as Paul said, this is just one tool in our toolbox. So, for example, if we've had a couple of red bars there in the middle of last year, but based on our liquidity and business cycle analysis, they were just perfect buying opportunities, as Paul said. So yeah, you can almost look at a red bar as a buying opportunity when you still see the business cycle expanding as well as liquidity.
And absolutely, that's how I view it, and we will see if we're proven correct on that. But so far, we've been very accurate on that throughout this cycle, and we're not expecting that changes today. The reason why we're not expecting that to change stems back from this core understanding of the global liquidity cycle, and this chart highlighting the longer term nature of what happens. We go up, we go down. That's just what the global liquidity cycle does. We're not actually, the little arrow on the end there is the high that we've achieved so far in this cycle. It's not where we are today, but looking at that chart still gives us confidence that it would be a very unusual cycle to end where we are. And in fact, Paul, I'll get you to really talk about that when we look at the current data, and when we look at this chart sort of zoomed in at where we are right now. We're still below that 50 line, which actually is not likely at all to be the top of this cycle from our perspective, is it?
No, and you can draw a line through that, and we're still heading up and to the right. So we've had, as Joey said, we're coming off one of the biggest inflationary events since the 70s. So understandably, central banks are really cautious to be easing, whilst they still have question marks around where that inflation's going. So they've been, quite frankly, absent. All the liquidity that we're seeing has been through the US dollar and bonds. So in their absence, it's been a slow grind out. But that chart is still, and we've got precedents where even in that last extraordinary rally where it touched that 50, came back down and then went up. Now these are more amplified, but we're coming off a more extraordinary previous cycle. But that's still heading in the right direction. And I think your next chart will vindicate that.
Yeah, and Joe, I want to ask you specifically about the point that Paul just made on the US dollar and the bond yields aspect of this, or the fact that there are underlying contributors to global liquidity that aren't necessarily the central banks, because we've had a lot of discussion about this internally. When you look at what's been happening recently and people who've been following along, because we do often put these sort of updates out weekly that dig into some of these numbers, the central banks have not been doing a whole lot. It's really been on the back of other factors that have been causing global liquidity to rise.
So a lot of people will quote central banks as the main source of liquidity, whether it be through the size of their balance sheet or even other executive branches of the government, like the TGA being drawn down, the reverse repo being drawn down, which is all liquidity positive. But what a lot of pundits forget and don't understand is that it's a lot to do with the liquidity multiplier. So you've got that orange there in your chart. So that's the collateral pool. So if your collateral is improving in value and becoming less volatile, then you can obviously borrow more against it. So with volatility in bonds, for example, we look at the MOVE index, and as volatility lowers over time, which it has been, the value of that collateral receives less of a haircut. And then you've also touched on the US dollar, obviously. So the US dollar, because the world funds itself a lot in US dollars. If you've got a weakening dollar, obviously those debts that are denominated in US dollars are easier to pay, which increases liquidity in the local currency of whatever nation has debts in US dollars.
And this data, of course, is from Cross-Border Capital, who look at this stuff in a great deal of detail. Paul, you've made the point before that when we look across the world, the story is actually not consistent with what we've been seeing in the major central banks, which is what Joe was alluding to there, that some of them are not really performing as well. But we keep coming back to this heat map version to say, really, it's a story that is divided depending on where you are or which players you're looking at.
Yeah, and it's that weight of contribution. So we just happen to be in the period where the biggest players, the US, Bank of Japan, China, Euro, UK, are all relatively neutral. So we've got a heap of various central banks, firmly in the green there, but those red to neutral shades are some pretty big players, and that's why we're just not seeing that come through. So it certainly gives us signs and comfort in terms of the consistency of the cycle. We're seeing it yet again, red to green and that to red, but it's those big players that are still sort of holding strong for now.
And when we zoom in, Paul, I'll keep with you on this one, because we can see it play out much more clearly at the weekly level, which incorporates all of the things that both of you were just talking about. Recently, the liquidity is actually been pushing up, probably getting us closer to levels because that is the all-time high levels at the top of that chart there, getting us back up into that zone where you can see that breaking out. Do you, purely from a global liquidity perspective, see that the potential is still there for that to keep moving higher, regardless of what the central banks are doing specifically? Because as we just pointed out, a lot of this was happening without them doing a whole lot.
Yeah, and I guess to put a bit more detail around it, so that previous chart of the Global Liquidity Index, that index is a pretty complicated metric, and so it does look at the direction or the trajectory, and it does it over a longer period. So, and you can quite rightly see, we've been sort of heading down since August last year, and a lot of that's been US dollar strength and that tightening of central banks. But we're certainly seeing a fairly since late January we're seeing this uptick, which coincides pretty much with the US dollar coming off and the bond market settling down, per Joey's comment. So take a lot of comfort from this, that it's heading in the right direction. And we should see that GLI start to tick up more meaningfully.
And we'll dig now into some of those specifics you mentioned about the dollar, bonds, all of that, through the lens of this deeper dive on the global macro cycle. Because what has been really interesting when you look at the US in particular. Growth, to me, on this chart has been showing that it just wants to take off. Now, whether you attribute that to the incoming administration that has arguably very pro-growth policies, some would argue that those policies are actually going to crimp growth, that they're going to be problematic. It doesn't seem to really matter. So far, what we've seen is that the components that make up this chart are moving in the right direction, and certainly have been since the election. So just for a little bit, Joe, you might actually want to provide a little bit of context around the orange line there, where we can see really that's looking very strong for growth. And that also incorporates things like inventories, so the build-up of inventories, and also forward orders. So looking ahead, it's looking pretty good.
Yeah, it does look good, and it's sort of what we expected in terms of potential legislation coming out of the Trump administration in terms of tax cuts and deregulation and forward investment for onshoring and expansion of capex for these companies and that operate within the US. I suppose something that I guess I'm starting to find a little bit more concerning, and we have touched on it the last couple of days, is the Doge administration coming in, obviously getting rid of a lot of employees and employees within the government who also hire civilian contractors. If you start to see significant numbers there, that's the kind of thing that can really stall out the economy in terms of, obviously people that don't have jobs are not going to be spending, right? So it really has that knock-on effect, and we can talk more about that later in terms of maybe that's somewhat of an engineered slowdown of the economy to try and get the Fed involved with refinancing the debt, which is due later in the year. But at the moment, it is heading in the right direction. But there's a couple of question marks in my opinion around where we're going to see that over the next 4 to 8 weeks.
And we may have just yesterday got a little heads up. So this is ISM's data, but S&P also do the sort of thing. They had a pretty strong off yesterday. And putting it down, the commentary around it was putting it down to just the uncertainty that's happening due to Trump's erratic policy changes and whatnot. So whilst we have on one hand, he's doing a lot of things that will be constructive for industry, he's doing other things that just scare businesses, and so we just don't know. It will be bumpy because it's a bumpy environment, right? And businesses take cues, and these cues just keep changing.
But to your point, it's uncertainty. And businesses don't like uncertainty. So, yeah.
And well, on the back of that, some things that I was reading around consumer confidence data was coming in considerably lower as well. And I think the narrative behind that was exactly the same, that it's not so much that consumers have particularly changed anything they're doing. They're just uncertain about the future, and that's leading to their confidence falling because they go, well, we don't want to make these big purchasing decisions when we don't know what the rules are going to be. So I think that does make...
And last night wasn't just Bitcoin, right? So we saw the Dow held strong, so that probably speaks to the tech or the growth component. But NASDAQ had a pretty nasty night, and the S&P, given that Mag 7's waiting on that as well. And even gold came off a bit last night as well. So there's a lot of uncertainty out there at the moment.
Yeah, you also look at bond yields as well. So bond yields dropped, which meant bonds themselves rallied. So, exactly what we're talking about there, we're potentially looking at some sort of a growth scare. The market seems to be less worried about inflation, which makes sense in the context of a lot of people losing their jobs, right? So the bond market's forward-looking and expects the Fed to step in, cut rates and then stimulate, or potentially stop QE and go back to stop QT and go back to QE. Then there's every reason why bonds should be rallying in that scenario.
You mentioned inflation. We've been saying for a while it's not really an issue. Still doesn't look like it is from this chart. I mean, this is from the first of the month. We're towards the end of the month now. So it's been bouncing around a little bit. But so far, I think we effectively have to discount inflation as being an issue, which would lead to, I think, Joe, you talk about this quite a bit, reinforcing where we are in that business cycle aspect of it, we're probably not late cycle yet because it hasn't taken off yet.
No, exactly right. And I think it's hard to get that inflation impulse that you usually see in late cycle when, one, the economy is slowing because jobs are being lost, but two, as you pointed out, if consumer sentiment is low, then people aren't going to spend as much, right? So it's very hard to drive inflation when people's mindsets are in defensive mode.
The elephant in the room we keep bringing up every month is the debt. You were making very good, both of you actually were, Paul, I think I'll start with you on this because you're making really good points about $9 trillion. That just keeps going over and over in my head, that the number that of that 36 that's on the screen that needs to be refinanced this year is huge, right? So just a massive amount of debt needs to be refinanced this year. We've been having lots and lots of debates. I'll move forward to look to the zoom in version of the previous chart, but pointing out that yes, Joe said the bond yields had pulled off a little bit last night and fallen down, which is what you would expect if there's demand for that government debt. But I'm still really worried about a huge amount of supply that has to be absorbed by the market later in the year. First of all, Paul, you talk me through how you're thinking about that. Then, Joe, I do want your perspective on that as well.
Well, can we just look at that red line at 4.33, right? So that there's about a quarter to a third of that 36 trillion that needs to be rolled over or refinanced this year. And a lot of that, I think the average is around 2% or something. So we are about the $1.2 trillion interest bill at the moment, and more than defence, they're paying in interest. That's at 2%. So they're refinancing. If they refinance now, it's at 4.3%. And so you can, and that's just the red bit. So the reality is the bond market, which is up even higher. So that's a fact. That's a, the debt wall, as they call it, is coming. And they can't afford to refinance it at these rates. It has to drop. They have to get liquidity in the market to refinance it. And the rates will be what the rates will be. So it's a pretty extraordinary setup when we're still at these heights, and we know what's coming.
Joe, what is this the argument for the controlled demolition, if you like, that there has to be a significant move in the markets here to allow aggressive cutting into that debt wall? Or are there other options? I'm struggling with this because on the one hand, I get worried because I go, well, what can they do? They're going to have to just refinance. Those yields are going to spike if nothing happens, like if there's no catastrophe, and it's all going to be creating its own catastrophe, so it solves itself somehow, I don't know. But if they had to refinance a chunk of that at higher rates, that's a problem. Then I think, could they just kick the can down the road again, right? Like even though the arguments have been you can't just keep issuing this short-dated debt, do they just issue more short-dated debt and push that the bulk of that issuance out one more year and see where we are in a year's time? I don't know. What's your view?
Well, they certainly don't want to be refinancing that debt at 4.5%, 5%, and issuing 10, 20, and 30-year bonds where they've got to pay 4.5% for that entire time. Whether it may sound conspiratorial, but in my opinion, as you pointed out, it may be somewhat of a controlled demolition. So Besant and the government, the Treasury know that this debt issuance is coming, right? So there's $9 trillion. And if you're going to scare the market, like if 1 year's already at 4.5% and you all of a sudden start issuing all this debt and you start pushing it 5.5%, at some point you get the Fed stepping in to tame that bond market anyway, right? Because that having a disaster in your debt market's not exactly what any government wants. We saw that in the UK a couple of years ago when yields spiked, right? So action was taken fairly quickly. So I think in terms of your controlled demolition, what you mentioned before, and what I also believe is potentially going to happen, the government needs the Fed to step in, right, at some point and help with balance sheet capacity, which we've spoken about before. That's basically the ability to issue this debt and have all that debt absorbed, which creates liquidity in the system. So that's also what's led me to believe, these layoffs and government sackings of personnel are potentially all part of a plan to get unemployment up, and force the Fed to cut rates and potentially start QE again to help with that debt issuance later on in the year.
Helped along by a crashing share market, which exacerbated as well.
Yeah, well, we know the Fed's two mandates are price stability, which is inflation, and obviously stable, obviously employment. But you can bet your bottom dollar that if the markets start being obliterated, or as in the stock market, or the debt markets blow up as well, they're going to step in and stabilise that as well.
Yep. The other thing we can't ignore, and I think Michael Howe of Cross Border Capital often gives this analogy or metaphor, is when it comes to refinancing debt, if you personalise that and assure home mortgage, frankly, it doesn't matter what the interest rate is, you do it or you're homeless, right? So if they can't orchestrate or manufacture this drop in rates, they're going to be forced at refinancing at these higher rates. That it can only happen with more liquidity. So they then have to find other ways. And then Powell's put himself in a corner. He said he's not going to do QE without zero rates. So we're into pretty dicky territory, and with the obvious levers being the US dollar, or forcing the likes of China to buy bonds with the threat of tariffs or something. But it's a really interesting setup at the moment.
But if all of a sudden you get, over the next couple of months, you start unemployment ticks up 400,000 personnel, that's a pretty good excuse to start cutting rates, and then which would eventually lead into that QE. So
yeah,
obviously the rate cuts.
It's the easiest out, right? It's the one that they have to somehow orchestrate.
And that's, I suppose, what is concerning me is if they just don't have enough runway, there's not enough time because they've left everything too late. They need to refinance the debt, but they haven't got enough time for the economy to smoothly come down. But Paul, you might have just mentioned the potential exit valve that could solve all of this, and it's the US dollar.
Yeah.
Now, if I look at this, ignoring everything that we just spoke about, I would be concerned about the US dollar going higher, which does not help the situation, right? Because I would be looking at the fact that we've got what would be very clearly there, a right translated cycle where, the sort of peak was to the right, which is generally quite bullish. It hasn't really collapsed since that cycle high, and we're heading towards what is typically the end of a cycle where a new cycle up would begin. So I would be worried that if I was putting all my eggs into the weakening US dollar basket, that looking purely at it from a technical point of view, we're not necessarily going to get that. It could be a good exit valve though, right? Like when you talk about manufacturing, maybe the manufacturing of some sort of crisis or a manufacturing of a solution, this wouldn't necessarily be a crisis because this would probably help everybody, would be some significant move that weaken the dollar.
And it does two things, right? So Joey talked about all the US debt all the global debt that's denominated in US dollars. But the other, probably the biggest elephant in the room is China's absence, right? So an absence is because they're trying to protect the yuan. So if you get a lower US dollar, all of a sudden they can be a bit braver with either monetary or fiscal response without the fear of that capital flight. So you open the gate to the biggest participant by lowering that US dollar as well, and then global debt of $350 trillion. The multiplier is huge. To Joey's point,
it absolutely is. Joe, do you? And this is just pure speculation, but do you have any ideas about the mechanics of how that would work? Because it's not clear to me how you actively devalue your dollar if you're the US, particularly if you're the US under Trump.
I think if you get that dollar down, right? So obviously the dollar differential with other currencies, operates on interest rate differential and mostly and rates, bond yields as well. So if you're the US and you're starting to get some low growth figures, and the market starts to see that, and they start to price in QE and rate cuts, then obviously that's going to be a increase of dollars into the global financial system. So that's going to drive the dollar down. So that's when we say that it's manufacturer engineered, with employment dropping and growth slowing and whatnot. That's what we mean. And having a lower dollar is all part of that.
Yeah, and that actually does make a little bit of sense, that there are mechanisms in place that it's effectively become self-correcting if we start to see some of that data. Maybe my concern needs to become a little bit more nuanced over not just generally that we're heading into a difficult situation, but specifically that we're heading into a situation where they can't bring the dollar down because you've got competing policies and there's an assumption that the dollar will weaken and it doesn't. Potentially, that's what I'm actually worried about when the more that I think about through the lens of how you're discussing it.
Yeah, I think the natural direction for the dollar is for it to actually strengthen.
That's what my concern is.
Yeah, so if they want to weaken the dollar, cut rates to near zero and start QE and throw out some swap lines with other central banks, and you'll get your dollar, you'll get your wish with a lower dollar. So I don't really see it as a problem. As soon as growth starts to slow, I think that's what we're going to see, a weaker dollar. Now on that chart there, you've got your cycle, your 26-week cycle. We're approaching somewhat of a low point over the next couple of weeks for the dollar. So we may see a low point and then a bit of a tick up or track sideways before we get a real weakening. We'll see how it plays out.
And potentially that tick up could be the seed of the actual fall of the dollar, because it might be putting additional pressure on particularly money markets that are screaming for liquidity, that just there's not enough liquidity in the system, that could be the sort of thing that causes some breakages there that ultimately leads to the flow-on consequences.
Right.
So all of that is so important. That whole discussion is so important against the backdrop of the big red chart, right? Like the big red candle on our Bitcoin chart. I'll go through this quite quickly, but we focus on Bitcoin because we know that global liquidity is tied to world wealth. We know that some assets in particular are monetary inflation hedges that respond particularly well to global liquidity. And we've spent a lot of time really recently focused on this chart, where we're looking at the sensitivity of particular assets to global liquidity, which is why we settle on Bitcoin. Paul, if you just want to give us a quick overview of this again. I know we touched on this last month, but Bitcoin is the decision that we made to be the play that we take here. It doesn't have to be Bitcoin. Like we're talking about big macro trends and big macro data that you could trade many things upon. Just remind us why it is that we settle on Bitcoin here and are actually very comfortable with that decision.
That big red bar. So it's look, you could argue Ethereum's a higher bar, but we've taken the view that we're going with the purest play in Bitcoin and the safest play. So and what that chart's telling you is that for a 10% change in global liquidity, you get a 10x in Bitcoin. So and the orange is telling us where we are over the 18 months, and we've still got plenty of room for Bitcoin to take off. If you note, gold is pretty much level with where it's going, and that's a lot to do with, I think, the geopolitical and the risk, I guess the safe haven play as well. But and then you've got silver, which is also very strong, but again lagging, and we'll talk about that later. But if the data says this is the best performing asset in a expanding liquidity cycle, then invest in it, but watch that cycle.
Absolutely. And it reinforces what we said the whole time, or from the very first sort of slide where we pulled up the components. We're picking the angle that we believe we can consistently maintain an edge in, because we understand what's actually driving these markets, as opposed to someone who's just watching a Bitcoin chart and just reacting. We're going, well, we can react appropriately if we can see ahead of time what's likely to happen. And particularly when we're talking about everything that was just mentioned, the idea that no more global liquidity is coming this cycle almost seems nonsensical, right? Like it seems there's no real scenario that we can imagine where there's no additional liquidity coming against the backdrop of everything we've just described? Because, I mean, Paul, you always refer to it as just maths, right?
Yeah, it's 9.2 trillion reasons.
It has to happen.
Yeah.
Joe, we've talked about this a lot. I like to highlight that we've started a brand new trend. It might only be very small, but it's growing every time I update the chart. We really have had this pullback in Bitcoin that you can see in perspective when you look at it on this logarithmic chart.
Yeah, and I just wanted to touch quickly on Paul's point, effectively picking the fastest horse in the liquidity cycle. Why a lot of people wouldn't do that is this is due to the sensitivity of Bitcoin, right? So as this chart displays the momentum in liquidity, it doesn't take much of a drop in momentum or a pickup momentum to get those large price swings, which is really what steers a lot of investors away. So it comes down to being able to stomach that volatility to have the biggest gains. And, some people might go full bore asset allocation to Bitcoin, or at the very least, it should be a portion of your asset allocation to benefit from some of the alpha you're going to get over this in Bitcoin over other markets.
And Paul, looking at this chart in particular, when we talk about the rate of change sitting there at zero, you could argue Bitcoin has just held up extraordinarily well, given that it hasn't had really much momentum pushing behind it. If we start to see that really taking off because of the reasons that were discussed before, that's going to push that up very quickly.
Yeah, the orange bar will meet the red bar. I think there's growing awareness of this cycle and the reality of this new sort of fiscal dominance regime we're in. So arguably there's a bit of front running. Don't forget too, we've had all the Trump effect of now having a pro crypto US president and talk of reserves and all that sort of thing. So it's had a fair bit of wind in its sails, regardless or despite that fairly lackluster bounce out of the liquidity cycle.
This chart is one of my favourites that I personally keep coming back to get a bit of an indication of who's wrong here, whether it's Bitcoin getting ahead of itself or lagging. And this data was updated as of the end of sort of the last week, so it hasn't captured that big drop that we've had. But I think it's quite clear when you think about where that blue arrow is at the moment, sort of sitting down under 90,000, that it's pointing in the wrong direction. Joe?
Yeah, it's exactly what we were speaking about at the start of the conversation with global liquidity expanding and still being fairly, early to mid-cycle in the macro cycle. You got to look at this as a buying opportunity. If you were to recreate this chart, obviously, like you said, that blue line would be well under 90. So one of those lines would be wrong. And whilst we are currently seeing liquidity turning up and Bitcoin going down, you've got to look at it as, assume that the Bitcoin price is probably wrong. And I think you're probably going to flick through to your next slide anyway, which is exactly where we sort of were thinking would pinpoint a low in time, right about around now. So we have actually been waiting for this dip as a potential.
Well, yeah, and that's a really good point. And Paul, we were talking about this for many weeks now, that the absolute best, we referred to it as the most bullish timeline, being if we actually saw the price dip down into the high 80s, because particularly if it did it right at the end of that 60-day cycle, because at that juncture, we were going to be set up beautifully for a very normal retracement that you get in a bull market, and it ending exactly where it needed to end, with actually flushing the sentiment out, which I think is fantastic, because our other opinion up until then was if that didn't happen and it was just sideways, it was actually almost handicapping how high price can go in the next cycle because it hadn't really flushed sentiment out.
Yeah, I mean, that late rally, late last year, was extraordinary, and you just don't want extraordinary after extraordinary. You want to see the market settle, reassess, and then have, I guess, the clear air to have another rally. So, no, this is exactly what we hope for, and it's playing out beautifully.
And Joe, you were looking into this quite a bit, the actual number of liquidations. And when we talk about fear in the market, it's certainly that they did the trick. Right? There's a lot of people who are very concerned and got liquidated, like got wiped out.
Yes, I think over the last 24 hours we've had up to, I think, $1 billion in longs liquidated. So that effectively means that there was $1 billion in the market that were betting on the market going up, but were forced to sell their position, which, you know, coincidentally drives the price down lower. So when you eventually exhaust those stop losses into the market, that's generally when you get a reversal. And that's not to say that it can't continue going down if the longs start to aggressively start piling in again and the market does what it does and inflicts the most pain. But for now, it's definitely a good sentiment reset, which is what you mentioned before. And, you know, I wouldn't be surprised if we see a good bounce up towards that 95 round, a region where all the shorts will start to get liquidated, if that makes sense.
And you can see that's the value of this chart. You can see the clear air between here and that price. That the price could move up there quite rapidly, catching all of those people who capitulated and got out off guard, because then you're well back up into the mid-90s again before it starts to struggle.
Yeah, and the more time that passes, the closer those liquidation levels will come to the current price. So while it's clear at the moment, I wouldn't be surprised over the next 24 hours if you start to see those lines sort of move towards the current price and you don't get that huge bounce. But, you know, nothing's a straight line, and the market will move in all directions to inflict the pain on everyone before it picks a general direction.
I want to spend a bit of time on gold and silver, because there's been just extraordinary things happening in those markets, and we do look at them very closely, mostly because we use that as the counter mechanism to our Bitcoin trade. So when we say we want to be in the Bitcoin exposure during that part of the cycle, when it's not that part of the cycle where the risk really picks up, we want to be in the safety of precious metals. We brought this chart up last time, looking at the BRICS and friends versus the US, and just highlighting the fact that the rest of the world was catching up with the US gold holdings. I mean, well, whether they're there, we could talk about that quite a bit, I suppose, with the audit of Fort Knox forthcoming. But what's changed in my perspective, and why I wanted to bring this back up again this month, is we've seen a lot of rhetoric coming out of the US, out of the Trump administration, that really seems to be thawing relations with Russia in particular. We saw very positive engagement with India when the Prime Minister was over there recently. We've yet to see negative against China, but we never know what the administration will feel about China. But certainly the other big players who have been accumulating gold here seem to be increasingly aligned with US policy in a number of areas. Paul, is this leading us down a potential path that is quite positive for gold? In the past, I would have seen a lot of these other countries stockpiling gold because they wanted to hedge themselves against the US. But now I'm starting to think, well, if they're all sort of thinking along the same lines here, this could actually be different. I might have been wrong there.
I mean, it's certainly a massive shift, and you can pretty much get rid of the verses now, it seems. But this could be, you know, keep your enemies close tactic. It could be if you go right out on the spectrum. If you know, with all the talk of revaluing gold, you know, if they revalue gold to where it is now in the mid 2900s, it only unlocks 800 billion, right? Doesn't fix a $36 trillion problem. To go higher than that, then you're enriching your so-called enemies. So if you're no longer, you know, acting as enemies, then you may be more open to that idea of you know, China's a massive gold holder. So if you were to revalue gold much higher, you've just, you know, given them a leg up. So I really don't know, and I don't think anyone other than Trump's own head knows where this is going. But
well, that in itself might be
but
questionable.
it's, you know, we've got to put this in the lens too of just the sheer amount of gold that's been repatriated into the US. and whether that's repatriation or just sending it. So we've seen London effectively empty. 400 tons of gold's been sent to the US within the COMEX. And London's gone to waiting periods to get your gold. So there used to be immediate delivery. So there's cracks showing. So there's that dynamic as well. So of all this gold going to the US. So it kind of feels like people are wanting to go to physical to further de-risk in all this uncertainty. And then that chart just keeps, that's 2,700 at whenever you did that, the end of January, where we're sort of mid 2,900s at the moment.
And we're pushing towards that 3,000 psychological level.
But look at the news. We've had all that physical gold going to the US, dressed up in the rubbish narrative of tariffs, and we've addressed that in our own news. That it, quite frankly, it makes no sense to make it difficult for gold to come into your hands. So it looks very clearly like either the full conspiracy filling Fort Knox before the audit, or just a whole lot of participants wanting the physical and removing the counterparty risk. And then we've had the revaluation talk too, in terms of revaluing gold on their balance sheet, and then monetizing that. So there's a lot of things that have probably put gold ahead of where you'd expect it to be right now. But what that chart shows is it still beautifully follows the direction of liquidity, with near perfect correlation. So,
and Joe, we've talked quite a bit internally about the idea of these Basel III, Basel IV regulations as well, and just the opportunity it provides that gold has been absolutely undeniably classified as a tier 1 asset. So if you're a large bank, if you're a large global player, whether it's government, whatever, you can hold gold and have the same financial benefit as holding government bonds without yield, but it's certainly been outperforming any yield that you would have gotten on those bonds. How big a part do you think that that's potentially playing in this repatriation? Because it needed to be physical. That was the kicker there. It couldn't be, well, it could be. You could have sort of gold shares or unallocated, but it was a much lower weighting given to it, whereas it was 1-to-1, pure valuation given if you were holding the physical.
Yeah, and that's exactly right. Gold derives a lot of its value from holding the underlying asset because it has no counterparty risk, right? So, we got a lot of geopolitical tensions that Russia was on the wrong hand of this, where a lot of their assets were seized. So having the physical asset and assigning it a tier 1 asset on the balance sheet, it makes sense, right? So I don't really know where it's leading to, and we're speculating a little bit that that's why a lot of the gold being repatriated to the US. But if that is the reason why, it's very hard to be bearish on gold, even though we've had such a fantastic run over the last 12 months. I'm sure over the next 12 to 18 months we'll figure out exactly why it's moved in this direction, and potentially when we do find that out, that might be a sell the news. But at the moment, it's just been relentless with zero pullbacks. It's been bid after bid every time you get a pullback, small pullback.
Well, I mean, all this is hitting the news, right? So it's just starting conversations that a lot of people never had. So between auditing Fort Knox to Basel IV to repatriation to revaluing the balance sheet, it's gold's been in the headlines a lot, and the penny's dropping. That why this is happening, I think.
And that's really interesting as well, because even though that penny is dropping, we make the point here, from a retail perspective, seeing foot traffic increase, yes, but not at levels that we've seen in the past. But then the dollar value, the average transaction value increasing, which would tend to indicate that potentially smart money. I don't know how you would look at that, Paul, but there's certainly a move happening with certain participants in this market.
Oh, definitely. Yeah, absolutely. So revenue-wise, it's well up, and because of, if you want to call it the smart money, but bigger money's coming in. Either that could be individuals or super funds, but but the foot traffic's sort of normal. So it's I think because you got to do the math, right? So it might be the more sophisticated players that are piecing this together and saying I need this in my portfolio. And let's not forget just the cost of living pressures in the country in which we live. There might be plenty of other people with the pennies dropping, but they just don't have the pennies left.
Yeah, and that's a point you've been making for a while, that lots of people might think it's a good idea but can't actually participate because they simply can't afford it. I need to turn to silver because we've been talking about this quite a bit recently. I've had this chart up here for a little bit while we're talking, but I really want to focus on the gold-silver ratio. It's just been absolutely extraordinary. I think it was up to 92 or something last night. We're seeing numbers that we really can't ignore. I know I've harped on about this a little bit. Paul, you have as well. Joe said recently that he even likes silver at the moment. So I'm going to put that on every
buy
video.
Signal. Yep.
There was a buy signal. But how are you thinking about this? Because I suppose the argument, the counter argument, if anyone were to be making one, could be, well, that's just because silver's done, right? Like silver's had its time. People aren't going back to silver. Bitcoin, they might look at as an alternative to silver potentially if they want more risk out on the curve. I mean, I don't buy that. What's your take?
And let's be frank, the alternative, or gold's going too strong. So, but and I refer back to that liquidity chart too. You could see silver lagging, and silver lags. Like we're talking over and over again today about where we're in the later parts of the cycle, right? So we expect the cycle to top out, later this year. Well, that's what silver does. It lags, and then it comes in strong, late in the cycle, and then that's normally when gold's also taking off, and then silver just slingshots past it. So this is a pretty well-worn path, and that is just a tantalizing ratio that you can't ignore. And for all the hogging of the headlines that gold's getting, silver's in very tight demand. So South Korea's, we did an article last week, South Korean banks have put a halt to silver deliveries. Just some of the volume of silver going into India and China of late is just mind-boggling. And this is all in the backdrop of Metals Focus and Silver Institute, outlining a 5-year deficit, and we've already had a few, right? So it's got very limited supply. The demand is, and again, because it wears two hats. So it's got the industrial use, and that's solar panels, EVs, electronics, medical, all of these things that are going strong, and there's no air to overtake it as the best metal to use. And then the monetary side, because people can start to, for some reason, think that gold's too dear, even though it's very fractional, and start to think, I'm going to tip into silver because it hasn't had the same rally as gold. So you get that dynamic at play as well. So there's so much aligning right now in terms of the supply and demand and then price dynamic that a GSR around the 90s is just too hard to ignore.
And what I find really interesting, I was just going to say, in terms of what we saw in the silver run when it was during the end of, or during that COVID period and the Wall Street bets, that sort of angle, where it did get the attention. And that's what actually I find really interesting, is that you make this point that no one's talking about silver, right? Like, even though these dynamics are there and it's making new highs and it's absolutely set up, no one's talking about it. But when they do talk about it, the moves that can happen are just extraordinary, as we witnessed during that period of time.
Yeah. And the chart doesn't capture it, but the biggest one we got was in 2013, where it dropped to 30 to 1. So you apply 30 to 1 to the current price, and you've got sort of $150 silver. So it's the moves can be quite extraordinary when it reverts.
Joe, do you have a point?
I was just going to say, and what Paul was talking about in terms of industrial demand and why we like it and why it makes sense later in the business cycle is obviously because you get that credit expansion. People buy more cars, they buy solar panels, industrial demand actually grows naturally with the business cycle, which is why you do get that pickup in silver. And once you get that little bit of a pickup in silver, that's when your speculation comes through. So that's like those being the two drivers of silver at the end of the business cycle, which is why we're starting to like.
And no ability of supply to keep up. It's an inelastic
because it comes on fast, right? Like to set up a silver mine takes
they just can't mine it that quick. That's why it has intrinsic value.
Joe just said why we're starting to like it. The rest of us have liked it the whole time, Joe. I'll just point that out.
Hey, if I'm
This
right,
monthly and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. We've moved past that topic, so Joe can't say anything else about that now. Did that very strategically. Okay, so we do like to just keep everyone up to date with our simple trading plan, and it really is very simple. The whole concept here is just buy low, sell high. As funny as that sounds, but we're really using what we talk about, that global liquidity index data and the trend direction to tell us where we are in the liquidity cycle. We look at where we are in the business cycle, all of that combined together to say, okay, yep, we're confident that we are turning from down to up or up to down. We'll put our signal in. That doesn't happen very often, as you would expect, because this is a longer term, effectively buy and hold trade, but we're trying to capture or protect ourselves from those significant drawdowns. We bought on the 10th of January 2023, and so far that trade, even when you have big red candles like what we've been experiencing at the moment, has performed exceptionally well. So 778 days, 416%, which is nearly 200% annualized. And that is just extraordinary when you really step back and think about that, considering what it is we bought on that date, and we've done nothing to that since. So we'll continue to follow that trade along so everyone can join in that with us and take advantage of that over the cycle. But that's really our analysis for today. We've covered quite a bit, I think, and we said at the start it's a really interesting time. There's a lot going on in these markets that are really important to keep on top of. I'm just going to ask everyone for the sort of wrap up. I'll just start by reiterating this point that framework to me is the most important thing that we can offer here, is a consistent framework. Because when we get a really difficult period of time like what we're experiencing now for Bitcoin, where you've got signals saying one thing but the rest of the market saying something else, that's the hardest time in a market to maintain your conviction, to maintain your position, to not get shaken out. It is very difficult to do. So our approach to that is to consistently deliver this data, this analysis in a consistent way, to keep challenging ourselves, however, to make sure that we're still looking at it correctly over the cycle. That's how we believe we will outperform. So that's my key takeaway for this month, is keep following what we're doing, because it's really important to maintain a consistent approach. Otherwise, you are going to find yourself, firstly, not being able to sleep well at night, but secondly, missing out on those big moves because you just made the wrong choice because you didn't have all the information. Joe, I'll hand over to you.
Yeah, the only thing I'll add to that is there is potential with what's going on in terms of slowing growth in the US for the market to have a little bit of a tantrum. That's very, as you pointed out, this is potentially the most bullish timeline. So look at that as a buying opportunity if it somehow happens between now and next month. Not financial advice, but I'd certainly be keeping an eye for that and be loading up.
Yeah, I from my point of view, I'm probably of a growing conviction that of the orchestrated outcome. As I said before, there's 9.2 trillion reasons why they have to somehow get rates down or an excuse to open the liquidity taps. So, to your point, as Buffett says, be greedy when others are fearful. But you can be greedy with that context, that the math says liquidity's got to come, and history says that these are the best assets to hold when that happens.
Look, thank you for that, both of you today. Really appreciate your insights and work behind bringing that all to our audience. I know the audience does appreciate it. If you have any feedback or want to continue that discussion in any way, feel free to reach out. You can follow me on X at Tipper Analytics if you want to stay up to date. A lot of this stuff, as I mentioned before, we post the weekly information there. You can also follow the Ainslie group at Ainslie Bullion on X is probably the best way to do that. They're also you'll find by searching on YouTube and Facebook as well. So follow along because we do put this information out all the time. Paul referenced a number of articles as well, so make sure you do that. We'll be back in March with our next monthly update to reassess and identify what's changed. But until then, and until we chat again, good luck in the markets, everyone.
Thanks, Chris. Thanks, Joe.
Okay.